Malik D, your financial credit guru, the hitmaker, the score. Fox Soul's #1 financial podcast. I'm here today with my co-host, tax accountant, economist, Dan Green, and also I have Wes Weston. He's an underwriter. He's also a realtor, and we get ready to dive into having a conversation about what's going on out here in this economy, in this housing market, from an underwriter's perspective, since a lot of realtors out here seems to think that everything is still good out here in the housing market. Mm-hmm. And since these realtors out here are not properly informing their clients about this economy, dealing with the real estate sector, putting the FOMO out there still, fear of missing out, telling them that, well, you need to hurry up and buy because these properties is not, these people are not going to be giving away their properties.
Right.
These people are not going to be giving away their homes, even though we're heading for a financial economic downturn. We're actually in it right now as far as the recession is concerned. Right. So I wanted to touch bases with you to get deep into the underwriting aspect. At the same time, let's have a discussion about what's going on out here in the economy dealing with this real estate. So if you can, introduce yourself to my podcast listeners and my podcast viewers.
Okay, thank you, sir. The name is Wes Weston. Grew up in customer service. That's how I actually entered into financial services. Within those years, I was with J.P. Morgan Chase Bank, doing personal savings, doing customer service. Graduated to small business, worked customer service in the private bank, middle market. Then went on to the sales side of things, actually the person that you see when you come into the bank.
Yeah.
Became a financial specialist where I started off with opened up checking accounts and things like that, savings accounts, grew to the level of becoming a small business financial specialist, so helping small businesses on the credit side of things, credit lending. I actually achieved investment licensures, sold annuities, went over, graduated to a financial planning team, worked on financial planning with financial planning support. From there, that's just kind of rolling it up in one little meatball. Came down to Charlotte. Before I came down to Charlotte, worked over in revolving credit cards. Did that for a while. Came over to Charlotte. That's where I came down, graduated to mortgage lending. I started off as a loan processor for a couple of years. Then after that, graduated to mortgage underwriter.
Wow. Okay.
Was laid off at one period of time, then came back in as a commercial credit analyst where I worked on the business side of things, commercial side of things. And then recently experienced a layoff, well-renowned layoff where it was via Zoom, that company that I work for. I won't mention them because I don't want to.
Right.
But I was a part of that layoff.
And they laid off a lot of people. I mean, from that company that you discussed with me too.
Yes.
And it was abrupt.
Yes.
Out of the blue.
Out the blue. Actually, for me, it was like when I got laid off, it was the day before my birthday.
Really?
Yes, the day before my birthday. So, that was kind of crazy, But nonetheless, it's okay. And but took that time off to go get my real estate license. I'm not actually a realtor yet. That's a part, once I align myself with a real estate company, which I'll be doing next week. That's the flip of the switch.
Right.
And then go through that process and actually become a realtor.
But you understand that financial game between being an underwriter and the real estate game.
Yes.
Because it works hand in hand.
Yes. For many years, underwrote many loans. So I'm the person who says yes or no. I'm the person that issues the approval or issues the decline on the mortgage. Yes. Yes.
So tell me something about these subprime loans, because that's what they are. They subprime loans that actually just got rolled out from these financial institutions to the black and brown communities.
Namely Bank of America.
Yeah, mainly Bank of America.
Okay. What I can tell you is this. Anytime you start waiving credit requirements, making it very, very lenient. Sometimes that can be a positive. But whenever you start to ease up on lending guidelines, there's a time when it makes sense to do that. But when you take your foot completely off the throttle and you start making it easy, like the times of prior to the mortgage crash, where people were basically stating their income.
08, 09.
Exactly. When you start where people can just state their income, and you take away the credit requirements, the credit score requirement, minimum requirements, and things like that. When you start to do that, that's when it can become dangerous. That's when it can become dangerous, because an applicant that you would have normally held to this particular standard, you might not be holding them to that standard anymore.
Right.
And as you see what it's done to us in the past, you can kind of like history repeating itself.
History is definitely repeating itself.
You can be doing the same thing just over and just repeating the whole process all over again.
Mm-hmm. From what you just stated, as far as history repeating itself, from the current state that we in right now, do you see that we are heading there?
Well, a couple of things you have to look at. You have to look at the unemployment rate. Right now, specifically in my industries, I don't know about other industries, but underwriters and everyone that's in my industry are suffering right now because when interest rates go up, it hurts the mortgage business, especially the refinance business, because no one, the whole thing.
Who wants to refinance for a high rate?
Exactly. Who's going to go out and refinance a 2% mortgage with a 6% mortgage? No one's going to do that.
It's higher than that now. It's like 7.something% because the Fed chair Jerome Powell just raised interest rates again at 75 basis points.
Exactly.
Which what was it, about 2 weeks ago?
Yes.
Mm-hmm.
And it also impacts the first-time homebuyer market, and the purchasing market overall.
Yeah, if you're a first-time home buyer, do you want to buy in at 7%? No.
Not when last year you could have gotten it at 3.
Exactly.
Or earlier this year you could have gotten it at a much lower rate.
Exactly.
Mm-hmm.
Which is why people have to know when is the right time to buy. You got to understand where the market is as far as a buyer's market, seller's market, and right now we just came out. We're the seller's market. You put a home on the market, the line is across. Around everyone bidding and sellers taking.
That's changing now.
Yes, it's turning in the other direction.
Yeah.
But for a while, that right there, sellers were able to sell their home above
inflated prices.
Above list.
Yeah, exactly.
And I think another driver of that were the big hedge funds that came in and they were buying up properties and turning them into rental units, displacing actually brown and black and brown, and the black and brown community and poor white community, the middle class, lower middle class,
right?
Because they were artificially inflating the pricing of the homes, and it just priced a lot of folks out of the market.
Exactly.
And now they've cooled. They're not buying as many in markets like Charlotte and Atlanta and Nashville and places like that. And that seems to have had a major impact too over the last 3 months or so.
Yeah, anytime you have the big investors, they got the big dollars.
Right.
So they can basically. I'm pretty sure all of us who owns homes has gotten those text messages, and those cash offers. So
they call me all the time wanting to buy my house.
Mm-hmm. Exactly. So they could basically come in and buy your home for pennies on the dollar, and then turn around and make a profit. And squeeze out.
Or turn them into rental units.
Turn them into rental units. Exactly. And in my opinion, destroys the community in the process. And that's why you see a lot of the apartment complexes going up. There's no everywhere you turn in Charlotte.
Because people can't afford to buy, so they have to rent.
Exactly.
Yeah, everywhere you turn, you see an apartment complex being built.
Exactly.
And the rent and rents are sky high.
Skyrocketing. My sister-in-law alone, her lease expired, and she's watching a hike go up about $500.
Wow.
And if you won't pay it, you're out. Somebody else will come right in and pay it.
Somebody else will pay it. Exactly. And so what do you do? Right now she's faced with do I go back home and live with mom and save up, but then at the same time you look at it and say, save up for what? What are you going to buy now?
Right.
A $300,000 house, $350,000 house, $400,000.
A lot of people came out
even the average husband and the average married couple.
Two income
household right now. I got some statistics here that from blackdemographics.com. It's like it talks about the incomes.
Yeah.
And this is because a lot of times people hear, "Oh, I make $60,000 a year. I make $70,000 a year. I make $80,000 a year." They don't, it sounds good when you hear that number, but when you actually start to break it down,
and you're trying to buy a $400,000 house.
There you go. So, for example, I'll give it to you at $100,000 a year. $100,000 a year from an underwriting standpoint yields $8,333 a month, right? That's gross. All right, and most banks will, even at the most, at the maximum,
most liberal,
allow you at 50% debt to income, which I think is a stretch.
Right.
50%.
That's back to the old days.
Exactly, which is a stretch.
Let's take a quick break real quick to pay these bills.
Okay.
And we're going to jump right back into this conversation, the school.
Gotcha.
Back to the school. We got Wes Weston right here, underwriter, and let's take off on where we left.
Okay, what I was saying was let's take a look at someone who makes $100,000 a year. Monthly, that equates to $8,333, right?
Gross.
Gross income. You take that at 50%, which is the common max that most lenders will lend on. It used to be when I first came in.
And that's combined debt to income.
Combined debt to income. It used to be when I first came in, 41, 43 was
exactly.
you needed an
the
exception.
High 30s
Exactly. Now they're going all the way up to about 50%, which I think is dangerous.
Which was harking back to the days of the early 2000s.
Exactly, which I think is dangerous, 50% of anything.
Yeah, because we did have a recession back in 2000 as well, too. I mean, you had 2008 and 2009 came in.
Yeah,
1999, 2000.
Yeah, that was more down due to the dot-com bubble.
That was the dot-com.
That had nothing to do with real estate.
That was the dot-com bubble, yeah.
The late 2000s had to do with the real estate crash.
Okay.
Exactly. So when you take that number and you slice that in half, that means that $100,000 household, to qualify, their income can't, you're looking at really $4,166. So when you take that number right there and you take a look at, let's say a $300,000 home today at 6% today.
Right.
That payment alone, just principal and interest.
7%. Because the rates just went up.
Okay, but for the case of argument,
I got you.
I went out there and used 6%. That, and without even including taxes and insurance, HOA, and anything else that applies, you're already at $1,799 on a $300,000 home.
Wow.
So when we talk about the middle class, I actually describe that as the middle poor.
Exactly.
Because what that basically means is, if one, and that's combined, a total combined household income, that means if one person loses their job, you're already in trouble.
Exactly.
You're already in trouble. And here's something that the banks do. The banks go by gross income. I've always argued, this is just the way it's done in lending, I've always argued that I think it should be based on net income, but then nobody would qualify.
Right.
Then nobody would qualify. So when you look at it from a real standpoint, what you actually take home is what you actually use to repay your mortgage. And so then we're not even looking at, the regular day-to-day stuff. We're not even talking about the car insurance. This stuff is not even included in that
utilities.
number. Right. We're not talking about utilities. We're not talking about car insurance. We're not talking about food. We're not talking about gas. We're not talking about transportation. We're not talking about shopping. We're not talking about
necessities.
Exactly. We haven't even gotten to that. So you basically are walking in to, like I said, you basically end up where we were, like you said, 2007, 2008 levels. It's dangerous.
And that's exactly what's circulating again, because a lot of people don't think that we're in a recession. You could tell by like you stated, you could tell by the housing market. The housing market is declining right now, while interest rates are increasing. But you got these realtors out here putting it out here with these individuals like the housing market is still good. And then they were like, don't expect for nobody to just give their house away.
Right.
You know what I mean? It's not about giving their house away. It's about properly informing your clients about what's going on out here in the economy, dealing in the housing sector, so they don't end up being upside down in their properties with these high-ass interest rates out here, and at the same time still with these overinflated ass properties. Because they still overinflated. Yeah, they're declining 20 to 30%, but we need to come all the way down to 40 and 50 and 60% where it could create that balance with the interest rates already being high. If the interest rates are super high, who cares? As long as they bring the prices down. As far as declining on these properties, they bring it down to 40 to 50 and 60%. So from an underwriter's perspective, how you view that?
Well, a part of that responsibility as well can also be to be given to the borrowers themselves. Whenever you lack awareness, when you lack awareness, you're not aware. I don't think we can put it.
And our community, and our black and brown community, isn't really aware of what's going on. They just going off what the realtor is instilling in them, which is that FOMO.
Exactly. Yeah, to some degree, but I don't think we can take the entire responsibility on the realtor, because just like with anything, if you walk into
consumer needs to be educated.
Exactly. You have to definitely go out.
But that's the realtor's job to properly educate their client too, even though they in it to make money.
Actually, a realtor has to be very careful around giving advice. So they're not actually allowed to give advice. Because then you step into a whole nother, you step into taking that and operating in the form of
it's ultimately up to the consumer.
Exactly, it's ultimately up to the consumer. So yeah, I see what you mean. Their job is to sell a home or bring a buyer and sell it together. That's their job, and they're going to do that. But another thing is, when somebody has it in their mind that they want something, that they want to buy something, a lot of times they don't care. People, as people, this is where we have to educate our, black people. When we have that unfinished that we want something, we're not. We close our ears, to reasoning, and we just
blindness on.
Exactly, and we want what we want, and forget all that. I just want a home. You don't.
And I want this one.
Exactly. I want the grand accountants. I want this.
And don't give a damn if they upside down.
Exactly. Do you know how many people actually, there's something that we call first payment default.
They're doing it in Atlanta, Georgia. You late one time on that property, they start that foreclosure process.
No, what I mean is, do you know how many people, after they actually close on their mortgage,
that they accumulate a 30-day late?
The very first payment they're actually late on.
Because they can't afford the house.
Ratio? What is the ratio?
I don't have the stats on that, but it's very
increasing.
It's very common.
Is it increasing now?
I can't speak on it because I haven't looked at the stats, but I just know from being in industry, because those type of things would fall back on us as the underwriters. There was something called post-closing, and so when that would happen, when the sometimes the loan get kicked back from the investor, or they had a post-closing team that would actually go back and review for quality and audit standpoint. They will, when that happens, they go, okay, why did this happen? You approved this loan. Why did this person miss their very first payment? That falls back on the underwriter. That means I missed something. That means I qualified a borrower who was not qualified. But that happens often. A lot of times in lending, there's, of course, obviously there's pressures and things like that.
Yeah.
But, as underwriters that you're getting, there are deals that they, there's undue pressure sometimes on us as underwriters.
With the statement that you just made about, you would be surprised how many people, at the moment that they close on them properties, the following month, or the following 45 to 60 days for the grace period that they have before they actually make initial payment. Because when you close on a property, you get that grace period of 45 to 60 days.
You know what most people do in those 40?
Depending on the time and how much you close.
And you know what most people do in those 45 to 60 days? They see that as free money.
Instead of saving
that money and keeping it in the bank, they see it as, okay, I can go out shopping, I can go do this, I can go buy a brand new car. We see a lot of that right in the mortgage process.
They'll keep their debt to income ratio down, and then right after they approve and then go after it's closed, then they'll go out and buy.
Yeah. So like I said before, a lot of this is habit.
Stupid.
It's mindset that people have to, a mindset that people have to have. And part of it is education, as you mentioned as well. Understanding these numbers and how these numbers work when you're actually going to buy a home. So I come from a time, if you probably remember, as a young boy, I remember, aunt and uncle getting together, renting for years and years and years, saving up.
Save up their money.
The old way it used to be, you're saving up. And I remember my aunt and uncle buying their first home at 38 years old. He was probably 42 years old, because back then that's what they did. They rented, they saved. You came up with the down payment. Now today you have a 22-year-old can buying a $300,000 home because they got an 800 credit score. You understand? So when they have no understanding on, it's like the child that gets that credit card in in college. Have no understanding of how this
credit utilization, debt to income ratio.
Exactly.
Not properly knowing how to use the card.
Exactly.
But let me ask you a question. And I'm jabbing at you, trying to poke at you, because I want to get the answer to the question that I'm asking about the economy in this state right now, where individuals jumping out there buying these overinflated ass properties. What current state can they possibly place themselves in from an underwriter's perspective, as far as like being upside down in that house, etc.?
This is exactly what happens. Okay, so
that's what I want to know, because I want to educate the people. Because you got people right now that's in the process of still thinking this is the right time to buy.
Okay, so this is going to kind of bridge off my investment experience. Anyone that has invested in before, especially if you traded stocks or anything things like that.
Of course, we deeply.
Exactly.
Me and my co-host, we deeply invested into the stock market.
And I can't speak on that because I'm not licensed anymore. But what I will say is, generally, people know you buy low, you sell high.
Of course.
That's where unless you're a hedge
you buy low, you sell high. You buy when it's blood.
Unless you're trading.
You buy when it's blood in the streets.
Exactly. So
let's take a quick commercial break.
Okay.
So we can pay the bills.
Gotcha.
But we're gonna jump right back on this.
Gotcha.
The score. Welcome back to the score.
Yes, sir.
Wes Weston. Let's get back to where we was at.
Yes, sir. So what I was saying, typically what people do is in the art of investing, you buy low, sell high, unless you're kind of there's different type of investment. But that's typically you want to earn a profit. You buy something low, you sell it at a high price. Well, what's going on in the market is, remember, a lot of the homes are being sold at the highest price right now. Yeah. A lot of these homes are being sold above appraisal value. So not just
they overinflated.
Not just listing price, appraisal value. So the appraisals are actually going out appraising
because of
properties.
what the hedge funds have been coming in and pushing it and forcing consumers to pay more.
And people are desperate because they want housing. Think about it. If you've been over here in this apartment complex, and maybe your house size is growing, maybe different things are changing in your household, and you want, or you just, I know for me, I was ready to have my own.
Exactly. And the thing about it is, you can buy. If you have decent income, you could buy a $400,000 house when the rate was 2%,
right,
or 2.5%.
Exactly.
Now it's triple.
Yes.
And so your payments
are much higher.
Yeah. That's why that also drove the pricing of houses because the money was so cheap.
So you're buying at the highest cost and at the highest selling price.
Exactly.
You normally want to, most of the time when people come in, they try to ride the wave, they come in at the top of the wave. And so like you said, then it's about to go in the other direction. And that's how you actually get caught with negative amortization. You buy a home, let's say at $400,000, all of a sudden the values in the community begin to drop because they were never valued at that from the begin with. They start to drop. Somebody in the household loses their income, or you get in there and you realize that it's a little strapped because you got to prove that a 50% debt to income, and you're ready to refinance, and you can't do that because the rates are, you bought at the highest rate. You're in trouble. You're in trouble. That is stress beyond stress. So,
and I think that's going to slow the market substantially. I think the fact that the rates are going up, it's going to force the consumers to hold off.
Right.
And they're going to wait for the rates to stabilize and start going back down, which, depending on what the Fed does, which could be years. Really. Seriously.
The Feds are going to continue to keep
because
on
they're going to
rates.
fight inflation.
Yeah,
they want to. The main thing is to fight inflation and get it back down to 2%.
Keep on hiking up those interest rates.
Exactly. To get until inflation gets down to 2% again.
Exactly. Well, that's what you got to do to slow it down.
Right,
you have to raise the interest, the cost of borrowing. So
which makes things more expensive.
Yeah.
Which makes things more overinflated.
Now let's just hope we don't get back to the late 70s, early 80s.
Ooh. Right.
I remember that when mortgage rates were 18%.
Yeah, exactly.
18%. My brother when he bought his first house, his interest rate was 18%, and that was a prime. That was outstanding. He had AAA credit.
Exactly.
And the prime lending rate at that time had gotten to 20% for businesses.
Wow.
The prime, they don't even use that term anymore, but that's if you had outstanding credit as a business, the prime rate was 20%.
Can you imagine that today? That would bankrupt most households today.
That would kill the real estate industry.
Exactly.
That would
exactly.
But his first house was probably $50,000.
Right.
So, and it was a nice house, but it was rural Alabama.
And that's a good point. See, and prices were lower.
Yeah.
The cost of homes were lower back then.
Substantially lower.
20% on a $400,000 home today, man. You're done.
Yeah.
Stick a fork in
it. You ain't tell me. You're
done.
That's crazy.
Exactly.
It's insane. Everything is relative, but I think the rates, with the rates being where they are now, and you've had two generations of people growing up, home buyers, that could never see double-digit rates.
Right.
They've been seeing rates in the single digits. And definitely the last generation.
Exactly.
They don't even know what that's like.
Right. Exactly.
They're going insane over 6 and 7%.
And here's the thing. This is what's scary for our children. Like I got two kids that my daughters that went in the Air Force, and and they're going to get 100% financing because they're VA.
VA.
Yeah. But we ask ourselves, when our children come, what's out there for them right now? I don't want my daughter coming out of the military or deciding to buy a home while she's in and paying $300,000, $400,000 for a home. You understand? You understand what I'm saying?
Of course.
Most of the time they start off with starter houses.
Exactly.
Where are the starter houses at these days?
They're not building them.
They don't exist anymore.
They're not building them.
Exactly. Did I answer your question? Did I answer your question?
Yeah, somewhat. Yeah, you answered the question somewhat. I'm just trying to gauge it because I know we're in an economy right now where the housing market is declining. It's not declining at a rapid pace right now, but it's starting the process of declining as these rates increase. Go ahead, Dan.
My opinion is that the market, we're on a precipice, I think, of a collapse. And the reason why I'm saying that,
that's what I was looking for.
The reason why I'm saying it is because the Fed's going to keep pushing rates, and they're going to, and they've already said we're going to have we expect a recession. We're already in a recession.
We already in a recession.
I'm talking about a major recession.
Exactly.
And that's going to put downward pressure on the market. It's going to increase the inventory.
Exactly. So let me give you my final answer. I'm in total agreement with them. I think I didn't want to say it, but but let me just go ahead and say I think the bottom might fall out again.
Of course, yeah.
The bottom is going to fall out again. And what people have to be careful of is just sit tight for a while and let this kind of...
Yeah, and then the inventory will be there. People
That's
will
what
be
I
able to buy
was
houses,
for you.
and they'll be able to afford them.
Because
it might be 5 years from now.
Exactly.
Because we need to properly educate our community, the black and brown community. Now is not the time to really jump out there and buy. If you really look at the MLS list right now of the listing of these properties, like we stated, about 6 or 8 months ago, you place a property on the MLS list, it's gone in 24 to 48 hours. Right now, these properties is getting priced on the MLS list. It's sitting up there for 30, 45, sometimes 60 days now. So the market is like you said, it's going in reverse now. It was a seller's market. Now it's becoming to be a buyer's market. But if you sit tight right now, you can be able to get obtain or seize an opportunity to get some great deals, even though the rates might be high. Because they're going to keep on increasing interest rates. But as long as that housing market starts to decline, and it starts to decline at a rapid pace, it's going to balance and even itself out where you ain't even stuck out there paying them high payments. And don't forget, right now, while people are still running out there buying these overinflated properties, they did a nationwide tax assessment this year, and it's going to roll over into 2023 with these people taxes and the mortgage insurance increasing on top of the overinflated properties that they jumped into that they really can't afford to pay. So now they're going to get hit. Now they hit with the overinflated mortgage payment that they're paying. Now they did a tax assessment this year on taxes and insurance or mortgage insurance within those vicinities of those houses in each state because it's a nationwide tax assessment. And what's going to happen now, it's going to reflect more of their it's going to reflect more of a payment in 2023 on top of the payment that they're paying right now.
I wholesale properties sometimes, and I flip properties, and so I'm tied in with Zillow and Realtor.com a lot, and I get a lot of emails set up where I get emails on adjustments on properties and stuff, and a lot of properties now in some markets. They're dropping the prices. They've been out there, they're staying out there, and I also do stuff with the VA site and the HUD foreclosure sites, and they're dropping their prices now. Before they were not.
Supply.
And so go ahead.
I'm sorry. supply and demand is going to always going to. We're always.
That's the key driver.
Exactly. That's the key driver. Supply and demand, and so. The timing and knowing when the purchase is always going to be, is always going to be. The smart thing to do. If you buy at the wrong, whenever you're at the tail end of the hype, so to speak,
it's just like the stock market.
Exactly.
The guys who get in at the top, thinking it's going to keep going up, get killed.
Exactly.
And it happens all the time.
They get the rug pulled out.
The retailers, the retail investors get in.
Yep.
And then they get slammed.
People are normally like knee jerk. They hear about it, it gets hot, and then they decide to go do it. It's like I love to play roulette. You got to catch that dealer, you got to catch that rhythm.
You buy when it's blood in the street.
Exactly.
You buy when it's blood in the street. So you can ride the wave up.
Yeah.
You don't buy at the top. You buy when it's low.
I think it was Warren Buffett that said when people are fearful, that's when it's time to buy. That kind of feeds to what you're saying.
The fear and greed thing.
Exactly.
And that's and the thing about it, guys like Buffett, and they buy when the market is banging, it's crashing.
That's right.
That's when they buy.
But
they buy good companies or whatever, or good investments.
That's right.
And then they just ride it because they know it's going to come back up. They do not buy based on emotion.
That's right.
And that's what stupid investors do.
Exactly.
Or consumers.
Exactly.
It's everything. If you do it based on emotion, you normally get slammed.
Exactly.
Let's take a quick commercial break so we can pay these bills. The Score.
Gotcha.
Welcome back to The Score, Mr. Wes Weston.
Yes, sir.
Let's jump back into the conversation.
Yes, sir. I think he was making a point.
What was you making your point, Dan?
In terms of buying real estate or any other type of investment, the emotional buying normally leads to trouble.
Right.
It gets you in trouble. You have to. There's always a certain amount of emotion involved when you're buying an asset, especially a home.
Right.
I mean, that's the largest investment normally in during your lifetime, your earning lifetime. And so, but you have to step back and assess everything.
Exactly.
And look at the market and look at the timing of it.
Exactly.
You may have to step back and wait a few years, save some more money, wait. And like in this case, that's what I would do, because wait for the rate, because you're going to have an abundant amount of inventory. You may be able to buy a better house, a bigger house, a nicer house 4 years from now, one that you can afford, and you won't have the financial stress that you're going to be under.
I think it'd be less than that, Dan, because a lot of these builders right now got all this inventory out there, and these builders' lines of credit are being affected from the interest rate hikes that already got hiked up about a couple weeks ago, which is making payments more higher on these lines of credit to build out these houses that they got sitting on the market, and the inventory is sitting because people can't afford to buy these houses right now. So what's happening is that these builders is now get ready to be into a situation where they're going to end up filing bankruptcy. And then what's going to happen from that point, most of these builders is going to start dealing directly with the consumer, with the retail people, with the clients, to start bridging these deals.
Now, that's a possibility, but one other possibility is, which is what's been going on for the last 2 years, is these trillion-dollar hedge funds coming in and just gobbling up whole neighborhoods. So they're going to, and they see they don't need financing.
That's right.
They've got investor money.
Exactly.
And they'll go in and just buy up these.
Exactly.
So that's what's been hurting the consumer. The rates have been good. The rates have been great for the consumer, but these hedge funds have come in and caused the market to get inflated.
Think about it along the lines of when the pandemic happened, right? Someone that goes into, let's say, Sam's and buy, 2 packs of toilet tissue.
Right.
Then there's all of a sudden someone who has a bigger wallet, they come in and buy
exactly
15, 20. They squeeze everybody else.
Big bank take little
out of the market.
Big bank take little bank.
Exactly. That's exactly what that's exactly to
companies like BlackRock and some of these other big hedge funds. They'll just buy. They've got trillions of dollars.
Exactly, and they have the time to sit and wait it out.
Exactly.
There's no sense of urgency. There's no sense of urgency for them. So so that can happen as well. But I understand your point. But like when these are the market influences right now that are out there. So that's what we're up against. And this I see it happen in my neighborhood all the time.
Wow.
Yeah.
Now, one aside to that is a lot of these neighborhoods, a lot of these community, what do you call them? The community groups within these neighborhoods. Have filed local ordinances and petitions and stuff.
Yeah, I had to
block these hedge funds
that's exactly
coming
what
in.
happened in my neighborhood.
So that's one
For
good
making
thing.
those neighborhoods out of rental neighborhoods.
Turn them into big rental
It's
units.
taking the value down of the properties.
See, because what happens, I think the threshold is
Yes.
I think the threshold is 10%. I think it's
Right.
I think it's 10%.
Like that, yeah.
And in my neighborhood, past summer, we had one of the sit on the homeowners association board walking around because that's what's happening in my neighborhood. Buying them up and buying up. So they were going around, getting signatures. I think it was a certain number of signatures.
Petition.
Petition.
They did it in my neighborhood too, and we signed that petition too because we was trying to keep all those hedge funds from having these rental properties in our community that's bringing the value down in our community.
Exactly.
Right. Yeah.
Exactly. And it's funny because when I walk around my community, me and my son, and I'm walking my dog, I can say, not to take shots, but you can always tell who own their home and who don't.
Yeah.
You can always tell who own their home and who don't. Me and my neighbor across the street, that person over there, because we're the ones taking care of the yard, doing this and doing that. You can always, sometimes, not to say everyone's that way, but you can always tell the attitude.
Who's a homeowner versus a renter.
Exactly, how they take care of the property. So if you got an abundance, anything over 15%, that becomes dangerous to the neighbor. That becomes dangerous to the value.
Exactly.
Anything greater than 10% becomes. As a matter of fact, from a lending standpoint, when we review the appraisal reports, That's something we look at on the appraisal report. If
the percentage
of
rentals.
Exactly. We look at that.
Or foreclosures.
They definitely look at the foreclosures because if you're going to lend in a distressed neighborhood, that's automatically a problem.
That's a flag.
Yeah, exactly. But definitely, we look at the percentage of the rental versus the people that are renting versus those that own in the community as well. Yeah.
Now, Dan, you said as you being a real estate, I mean, you're an investor.
Right.
I mean, you do
wholesaler.
You do a wholesaler investor, and you said you've been seeing a lot of these properties starting to decline.
In certain markets, you see, you see them taking. They'll lower their prices. Their property will be listed for $250, and let's say it's been on the market for 30 days, then they drop it down $5,000, and I'll get an email. So yeah, that's happening now. It didn't happen. It wasn't happening 3 or 4 months ago.
Right.
But it's been happening towards the end of the summer. Now it's been for the last 3 months. It's starting to happen.
And that's the seller realizing that things are
they can't sell.
Yeah, exactly.
So,
and that's when you know it's about to be when it's turning into a buyer's market because the seller, they have.
And that's how you know we're heading for a deep, hard economic downturn.
Exactly. Because the seller, depending on their needs, they might need to uproot and move different things that are going on at the time. They may, like some people have job
motivated
offers.
sellers.
Yeah, job offers and other locations and things like that. And so they need that home to move. And if it's not moving, then what happens is they start to come down on that price. They start to come down on the price. That's like a signal that things are turning around. Things are turning around.
Yeah, I saw a 1,500 square foot house in Charlotte back in April sale for $400,000.
Yeah.
It was a brick house built in the 50s.
Yeah.
On Archdale. And I'm like, yeah. We were trying to put a bid in on it before it was already under contract. They put it on the market. And that by noon, it was already under contract, and it was listed. I forgot it was listed for like $380 or something like that, and they ended up closing on it for $420.
Yeah. You know something?
That's insane.
It is. The average couple today that are buying homes, even if are walking into $400,000 neighborhood. Typically, you would buy something, and I know we're not at these numbers anymore, but you're somewhere 200, 225, 250.
Back in the day.
Right. And then maybe if, you want to upgrade later on, maybe the husband someone got a better job, making more income, you decided to upgrade and you sell that whenever. But today, people are walking into $400,000 homes, $500,000 homes. That's crazy.
With the rates where they at right now.
With the rates where they are right now.
So they're going to be upside down in that house.
Immediately.
I looked at my old home, what I bought in 1988. I paid $86,500 for it. It's on Kuckenbaum. It's in Overbeck, over there off of Sharon Road West. I looked a couple days ago, $435,000.
Wow.
It was a nice house. It was only like 1,700 square feet.
Right.
Not no vaulted ceilings or anything like that.
Right.
3-bedroom, 2.5 bath.
Yep. Because I always learned that it's not how much something costs, it's how much is it worth to you.
Exactly.
How much is it worth to you? And if people are willing to pay the price, but to your point, we're in dangerous times because when the bottom falls out, then we're going to be, and then here's the thing that happens is when.
And my main thing is I want to make sure once again that our community is properly educated as to what's going on out here in this real estate housing sector.
That's right.
I'm trying my best.
And to
give them some freedom and culture.
So if I was to add to that, I would say the best thing that if you're going to buy a house, I would say, number one, clear debt out the way. That's first and foremost.
Right.
Take care of your debt. Because I already kind of went over the numbers.
Yeah.
You clear your debt out the way so that at least the only thing that you're looking at is, a mortgage, and maybe between the two you can do that, but if you're coming to
into a new situation in the debt and things like that, and trying to take care of this with a new bill now, you're gonna lose.
Exactly. So that's what. And then when it does turn around and the bottom falls out, and you can't even sell it to get to try to to get away from it, then you're stuck.
Wow.
And then right now, what's happening, like I said, particularly in my industry right now, job losses is when you couple that it's all good as long as people are working. When you get there, it's all good as long as but unemployment
is getting ready to to spiral out of control.
Right.
People are already, we talked about this earlier, people are already losing their 401ks.
Yes.
People are already losing their annuities. People are already losing their investments account. They're getting liquidated. They're getting drained.
Exactly.
People on these jobs now, these corporations are pulling back.
Yep.
People are getting ready to get laid off. And when you get laid off, when there's no type of resources or money being injected back into the economy because of quantitative tightening, you're going to end up losing properties, assets, the whole nine.
I'll give you another one.
Let's take a quick commercial break. So we can pay these bills. Welcome back to the school, Mr. Wes Weston, my co-host, Dan Green. Let's jump back into the conversation that we just got through before the commercial break.
Okay. To your point, I'll tell you what's on the rise right now, everything you just said, but what are people doing right now? A lot of people are digging into their equity, digging into their equity. You understand what I'm saying? Like you said, people, when
late 2000s.
Exactly. People are going into the equity of their home, cash out.
Piggy bank.
They're using it as a bank.
Exactly. When people, what happens when people...
But they're not going to be able to get that much out of their bank because of the interest rates already done hiked up.
Yes. Yes.
But a bigger danger, which is what I'm thinking you're saying, they're eating up all the equity.
There you go. They're eating up all the equity in the home, and exactly. And at the same time, running up credit.
Of course.
Running up personal credit, because when people typically, when they lose their job, not many have savings that they have, that they can pull from to, till they recover. So the first thing they do is they go over to those credit cards that they have,
max them out.
Or the next thing they do is they go over to this equity that they got, and they start pulling into that equity further.
But when you have nothing coming in, and you're constantly using these credit cards, and you're burning them out, and you're over leveraging these credit cards by maxing them out, and then you then took your equity out of your home. I mean, there's no more income coming in because of the quantitative tightening. Then you're going to end up damaging your credit. And then you're going to end up getting foreclosed on that property.
They've completely wiped out their net worth.
That's right. That's right.
Because what they'll do is they'll take the money out of the house, pay off the credit cards.
That's right.
Then they'll turn around and go right back and use the credit cards and max them out.
That's exactly what
And
happens.
then they're completely upside down.
It's a double whammy.
It's a small.
They're basically insolvent.
It's a small percentage that will learn.
Insolvent, I like that word.
Yeah, it's a small percentage that will go and pull from their equity, pay their credit cards off, and stop.
Exactly.
Most people will pull, pay it off, and all of a sudden start feeling that, because
they don't tear them up. They don't cut them up.
Exactly. Because remember, once you take that home equity, that home equity out, that payment, most of the time the repayment is over like 120 months. So so if your output and credit obligations were, let's say, $800 a month, $800 a month. By the time you took that cash out and paid off for that, you're looking at somewhere around maybe $250 a month.
Wow.
So then what do most people do? They say, okay, wow, I got an extra, what's that, $550 or whatever. They say, I got extra. So what they do, they go back out and,
run it back up.
I can go buy me another car, what I'm saying? So they start doing it, and it's just a dangerous.
And they still got the credit cards over here, and then they start, you know what? I can't make the payments this month, so let me just get a cash advance on my card.
Exactly.
And all that stuff so I can pay some bills with it or whatever. Or use my card.
Exactly.
Yeah.
What I suggest that individuals do is really take their finances very seriously, especially in this climate.
That's right.
Keep their credit stabilized. If you got any kind of credit issues, get your credit restored. Come on over here to me, www.malikdavis.com. Fast track, get your credit straight, because you're gonna need this credit while we're going through this recession.
That's right.
They're gonna need it in the worst way.
That's right.
Some of them be able to get lines of credit. Some of them be able to get these business loans, these business lines of credit to hold them up.
That's right.
It'll stabilize you.
That's right.
Because it's going to turn, but it's not going to turn anytime soon.
That's right.
It's picking up momentum now. But I strongly suggest that individuals, if they want to survive during this economical financial recession, they best to get their credit clean and maintain it and know how to leverage and use their credit.
Absolutely.
Once again, www.malikdavis.com. Fast track. Come and see me. Come and see my staff. Wes, from a realtor's point of view, looking at the housing market now versus back then from 2008.
Okay.
What do you see the difference as far as the numbers, even though we know it's been inflated?
Okay. The prices of homes, it's a different dynamic than it was then. See, in 2008, what happened was lenders were, remember the adjustable rate mortgages?
Yeah.
Okay, so the problem,
and no income, no doc mortgages, no stated loans.
Interest only.
Exactly, the interest only ones. So what did that do? you can get this home over here, and your payment is $300 a month, right? Mm-hmm. And so what the people did, everybody at that time wanted to go buy another property. So the problem then was, you have a person that knows nothing about real estate investing or real estate property going out buying. You have the average mojo going out and buying another house. Mm-hmm. You understand what happened when everything flip-flopped and turned and blew up? It just went kaboom. The difference is today is I don't think we have that problem anymore. The problem we have today is the prices of the homes is just completely inflated.
Yeah, exactly.
The prices today, the homes are completely inflated.
Because of cheap money and the hedge funds.
Exactly. Mm-hmm. So to answer your question, I see it kind of like what we talked about before. I see it just it's a dangerous. It's going to blow up if people don't stop putting themselves in that type of situation. You got to buy smart, basically. You got to buy smart, like what we talked about. You got to wait this thing out.
You wait till it's blood in the street. And if people don't know what blood in the street means, you buy low and you sell high.
That's right.
It's like that in the stock market. You buy low and you sell high.
That's right.
People jump out here and buy at the top, and then the rug get pulled out from up under you.
That's right.
When the downturn comes.
That's right. That's right.
And then they lose it all.
That's right. You want to hear some crazy? I went to blackdemographics.com, mm-hmm. and these are some of the just to give an idea where the median salaries in the black community lie at. Mm. All right. So now, right. So the median household income, $43,862.
Damn.
That's the median. All right. The median family income, $54,938.
That's in the black community.
In the black community, mm-hmm. African American. Right. So a married couple, somewhere, husband and wife, or couple, $81,545. Mm-hmm. So when you take that's the median.
Yeah.
That's the median. You take that and equate that to the numbers when I was talking about how much you purchasing in houses earlier. You can see.
You can't afford it.
You can't afford it. And the example that I gave you early on was based on the $100,000.
Now we're talking about $500,000 to $1 million. Now that's a totally different conversation. When you're talking about, you say based off $100,000, you got
$100,000.
No.
Oh, you're talking about income.
Income. When we first started the conversation,
Got you.
The scenario I gave you before was based on $100K income. Mm-hmm. So if you can imagine now, that's actually the number.
Based off 80-some thousand.
It's lower.
Yeah.
So that means
the average black
can't afford it.
They don't even. Yeah.
Yeah, and here's another.
I thought he was talking about the housing prices based off $400,000 versus for $500,000 to $1 million. I mean, as far as like what people's income need to be or whatever the case might be.
Right. No, I was talking about the example I gave you at the beginning of the conversation with the annual income.
Yeah.
So and here's another funny thing, like and this is like advanced degree. Someone with an advanced degree, mm-hmm. right? This is the average black male with an advanced degree. So with these master's degrees and all the education and everything, weekly salary $1,295. Mm-hmm. If you need me to calculate that,
you can calculate that.
You want me to calculate
that? That's a little bit above minimum wage.
Okay, right?
No. $1,295.
Yeah, so $1,295
a week.
Oh,
so it's about 60,000.
52, right? Yeah, right? 12. Yeah, $65,000.
Yeah.
So you get this, that, and that's what
that's an advanced degree. For the average Caucasian male with an advanced, it's going to be heavy six figures.
And for a black female, right, $1,133 with an advanced degree. So that's another thing to talk about. A lot of times, in the African American community, we're thinking that
that's a huge disparity.
Exactly.
When you compare it to the general population.
So we're not even talking about the cost of the student loan debt. Believing that
which is a whole nother
with master's degrees and things like that. This is on average what it's yielding. So the thinking is, I go out and get a
now, could some of that be the fact that maybe the advanced degrees might not be in fields that are high paying?
Yeah.
I mean, we're talking about not a master's in electrical engineering or computer science.
Exactly.
It might be a master's in African American studies.
Exactly.
So that's some of that's
exactly that's kind of baked into.
But you're making your point.
But the point is sometimes even in the black community is that the master's degrees and so far that it's going to yield this exorbitant income, and the stats show that
because a lot of them are teachers.
Exactly. The median income for those particular degrees don't even support these $300,000, $400,000 homes.
Wow.
You understand?
So what would you tell individuals here on this podcast, to our viewers and our listeners, about the housing market right now as far as going out here trying to buy at this point in time, at this stage where we at, and at this stage where we headed.
If you can't afford it, don't buy it. If you can't afford it, don't buy it.
That's the best advice you can give.
If you can't afford it, don't buy it.
Right.
And you definitely, if you're definitely out there in the purchase world, don't get me wrong. If the income is there, if the savings is there, if there's if there's stability in employment and things like that, nobody can foresee the future, obviously.
Right,
but
right.
if those things are there, and you're in the need for a home, okay. But I would tell people to definitely live within their means. So
now is the time to be saving.
Exactly. The problem is today, a lot of people want to live above their means.
Look, just to basically look good for the
Keeping up
neighborhood.
with the Joneses.
Exactly.
Looking good for the neighborhood.
That's the major problem right there. Everyone, what would have been okay 25, 30 years ago, everybody want grand counters, everybody want a swimming pool in the backyard, everybody want this, everybody want a bonus room, everybody want this and want that. And guess what? These, like you said, these real estate developers, they're gonna just take you through the showroom, and by the time you finish with that, you gotta, you have a $500,000 home.
People are
without the
paycheck
upgrades,
away, a couple paychecks away
Couple
from
of
being
paychecks
on the
away.
street.
First mortgage default, like I talked about. Yep. You lose one income, you're done.
Yep.
And that's another thing I would say. If you cannot pay that mortgage with one income lost in that household, don't do it.
Right. And the incomes
That's some very good
and the incomes in these households are getting ready to be lost because of the unemployment.
You're right.
It's getting ready to spike.
Exactly.
Because we've had a tight labor market for the last several years, post-COVID, pre-COVID, during COVID, and post-COVID. And a lot of those jobs, though, are not being filled. But those are high-tech jobs, a lot of them.
Exactly.
And now the general market, the general employment market is about to go nuts.
Right.
Because businesses are cutting back. Even Facebook, they've put a hiring freeze on. And some of the other tech companies now. So it's going to ripple. And of course, the big retailers and all that, they're all going to start laying people off.
And you know what happens when the finances go erupt? The marriage goes erupt. The number one killer of marriages is finances.
Exactly.
So a lot of times, then what happens?
But listen, pleasure to have you on the Score Podcast,
Pleasure,
man. We definitely got to bring you back. We got to go ahead and wrap.
Thank you
Malik
for
D,
having me.
your financial credit guru, the hit maker, The Score.